You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.
In 1990, Peter Lynch retired as manager of Fidelity Magellan, the nation's largest stock mutual fund, and one of the most successful. In 13 years, he drove Magellan to a 2,800% gain. Quite simply, Lynch has been recognized as one of the greatest money managers ever. He beat the stock market for so long not by timing the market, but by picking the right stocks. Of course, no one can promise you Peter's record, but you can learn a lot from him. And you don't need a billion-dollar portfolio to follow his rules.
Hi, my name is Peter Lynch. For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more. I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has. I'm here to help you find them and use them. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year. Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000.
When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, KEOs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you're going to do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down?
In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Many people ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow.
Your advantage in picking stocks is your direct experience in companies as a consumer, on your job as a professional or as a neighbor. Use those advantages as a place to start looking for good stocks.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products. You see some services that are terrific. We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash. You're paying almost nothing for the company. They had lots of other divisions that were doing terrific.
Buying that car turned out to be a great way to begin researching the stock.
Sometimes people take things for granted. My field was the mutual fund industry. In the early 1970s, the industry grew slowly, but then it took off in the 80s. Money piled in to money market funds, to equity funds. Like an idiot, I missed stocks like Dreyfus, Pioneer, T. Rowe Price, Strategic Investments, Franklin Resources. There was lots of companies that went up dramatically. These are my own field. All I had to do was buy these things. It was really dumb.
Back in the 1950s, a fireman from New England noticed a factory in his town seemed to be hiring and expanding all of the time. This person didn't have a Cray computer, and he wasn't a professional investor. He was just an observant neighbor. He decided to put $2,000 per year into TAM brands, then called TAM packs. By 1972, the fireman was a millionaire, just from using his local edge.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain. It's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
If you know something that will drive a company's earnings higher, you know something that will drive a company's stock higher, sooner or later. But you can't just guess at it. You have to have some reasons, such as costs are coming down or a new product's going to be a big hit. Research is developing a company's story, an idea of why earnings should go up or down. It doesn't mean sitting in the library for hours, reading SEC filings, or fiddling with a calculator.
Research is exciting. It's very little math. When I owned Chrysler, it was the biggest position in my fund. When I was at a movie theater, at a sports event, I'd run into somebody driving a minivan. I'd ask them, what do you think of the minivan? Would you buy another one? What do you like about it? People would say, well, it's a little underpowered. They only have a 4-cylinder engine. I knew they were already working on a 6-cylinder engine. So this is research.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job. I owned Dunkin' Donuts for 12 years. I think I might have talked to them once every year. The story didn't change a lot. You don't have to worry about low-cost imports coming from Korea when you own a donut company. You don't have to worry about the economy. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they had just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu. They kept their costs low. They added breakfast. They went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. Lots of good companies had nothing to do with wars, nothing to do with banking. They all went down in 1990. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. This is a company that's had 35 years of double-digit earnings growth every single quarter. We've had changes in the Supreme Court. We've had the stock market go up and down. We've had changes in presidents. We've had recessions. We've had wars. All of those things had no effect on automatic data processing. So every time the market went down, it gave you a chance to buy it. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam.
Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount. If you start by looking at the entire universe of stocks, more than 3,000 stocks on the New York Stock Exchange alone, and over 13,000 public companies in total, you'll blow a gasket. So I break stocks into categories, partly to make the job of researching more manageable.
Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company. You simply can't expect all stocks to behave the same. Basing a strategy on general maxims, like sell when you double your money, or sell when the price falls 10%, is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches, different expectations, and different kinds of stories. Suppose you've made a 50% gain on two companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return could be just the tip of the iceberg for the fast grower. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds. In the meantime, remember, categories are guidelines. They are not hard rules. Some companies may not fit neatly into a category. Others may seem to be in 2 categories at once. Almost all companies change categories at some time throughout their lifetimes. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclicals experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclicals again. Use the categories as guides to help you build your story, but don't let them limit the questions you ask or the research you do. One thing we can say about companies in general, it's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings. As well, good opportunities exist in companies that are cyclical, regardless of their size.
When most people think about investing in the stock market, they dream about investing in a fast grower, a company that is growing at over 25% a year. At 25% a year, a company's profits will double in 3. They quadruple in 6. They go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off.
The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money.
What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing.
One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to.
Microsoft was a company you could have bought 3 years after it went public and made over 20 times your money. Sales and earnings were growing at several times the rate of the companies in the S&P 500 in an industry that was exploding by leaps and bounds, and it had a lot of potential both overseas and domestically. This was only the beginning of a 15 to 20 year growth cycle. You had plenty of time to get involved.
There was this amazing company called Superior Industries. I think the stock went up over 100-fold. They were very good at making aluminum wheels. A lot of car companies went to aluminum wheels. The industry for autos wasn't growing. Aluminum wheels were growing dramatically, and they were the best at it.
The fast growers get all the attention in the media, but there's nothing wrong with slow-growing stock, provided you get it at a very decent price.
Somebody would say to you, I'm going to sell you a business for $100,000, and they're earning $50,000 a year. You say, what's the bad news? Let's say the bad news is the earnings are never going to grow. They earn $50,000 a year forever. So this is a price earnings multiple of 2. You pay $100,000 for $50,000 of earnings, but they're never going to grow. You say, I don't care. I'm going to get a $50,000 return every year. In 2 years, I get all my money back, and I'm going to make $50,000 a year on my $100,000 investment forever.
So sometimes, even if a company has a very low growth rate in earnings, if the stock is selling at the right price, it may still be a very good deal.
A slow to moderate grower will have earnings growth of 3 to 15% a year. One company that I was very lucky with was Service Corp International. It's a funeral home company that bought up local family funeral homes, a very steady business. Service Corp could grow earnings at 15% a year when I owned it with very little problems. A slow grower that turns into a no-grower is a very bad news situation. So when you start researching the stock, look for these signs. Steady earnings growth. Rising dividends. Companies that raise their dividends each year have to have the earnings to do so. A rising dividend is normally a good sign for a stock. Room to keep growing. You want slow growers to go on forever. That's one reason I like Service Corp International so much. This was a great stock for me in the 1980s. At that point, it had a long way to go. Cyclical companies rise and fall with the economy. Typically, they make expensive big-ticket items that people buy when the economy is good. Things like houses, cars, and furniture. When the economy is bad and people are worried about losing their jobs, they don't buy big-ticket items. They're too broke or too scared that they will go broke. Don't try to time a cyclical stock if you don't have intimate knowledge of the business, if you don't have an investor's edge. Everyone on Wall Street tries to time cyclical stocks too. Because the stock market looks forward, you could be left with a sinking stock even though the company's earnings are terrific. You make your best money in a cyclical when earnings go from rotten to mediocre, or from mediocre to pretty good. The danger point is when earnings go from great to spectacular. Somewhere between these 2 points, Wall Street will figure out there's only one way to go, and that's for profits to go down some point in the future.
Just don't buy in the hope. Wait for things to get better. Prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big.
Let's take a look at Chrysler. In 1990, the company was selling for $10 a share. The economy was lousy. People were talking about Chrysler going out of business. But guess what? The economy came back. Everyone's old car was falling apart. As people made more money, they started buying new cars. And because Chrysler had great products, the minivan, the Jeep, and its first new full-size truck in 20 years, the stock was big. And in addition, very importantly, the balance sheet was decent in 1990. This was not a company about to go bankrupt.
If it's a cyclical, you're hoping for a dramatic turnaround in earnings. It's going to happen over 2 or 3 years. Earnings are going to go from a loss to a huge profit. Stock's going to go up and you're going to get out.
Make sure you're picking a strong company that can survive when the cycle goes down. That means good cash flow and low debt. If its cash flow is spotty or its debt is high, when the downturn comes, the company faces the danger of going bankrupt. Turnarounds. These are stocks that are battered down, or they're hated companies, or they've been forgotten about. They're depressed in price. But you have determined some one thing or a few things that have the potential for reversing this company's fortune